Investing Made Simple. How to Grow Your Money Without the Confusion. Written by Ronnie Rowland. Published by Growth Literacy Lounge. Do not save what is left after spending, but spend what is left after saving. Warren Buffett. Let's be real, the world of investing can feel like a private club with a secret language. You hear terms like dividends, PE ratios, market volatility, and somewhere between the jargon and the fast-talking finance bros on YouTube, you start to wonder if this is all just too much. You're not alone. Millions of people want to grow their money but feel stuck. They're not lazy, they're not uninterested, they're overwhelmed. So instead of taking action, they wait, they scroll, they second-guess, and in the process they lose what matters most: time. This book is your permission slip to drop the complexity and finally move forward. You won't find formulas or flashy promises here. What you will find is clarity, calm, and a proven path toward growing your money, no finance degree required. You'll learn how to make investing work in your real life. Whether you're earning a little or a lot, whether you're starting at 25 or 55, this book is built for you. Because the truth is, most of the traditional advice out there isn't designed for everyday people, it's written to impress other experts. Not here. We'll walk side by side through each concept, cutting through the noise and making it simple. Together, we'll focus on what actually works, starting early, staying consistent, tuning out the chaos, and letting time do the heavy lifting. This isn't about getting rich overnight. It's about getting free eventually. If you've ever felt behind, embarrassed, or unsure where to begin, you're exactly where you need to be. Let's get started. Chapter 1. Why most people get investing completely wrong. Let's be honest. When most people hear the word investing, they picture chaos, stock tickers flying across a screen, guys in suits yelling into phones, charts going up and down like a roller coaster. And deep down, many assume it's not for them. Too risky, too confusing, too Wall Street. But here's the real deal: most people struggle with investing because they've been told it has to be complicated. They think success means chasing the next big stock, watching market news 24/7, and always making smart moves. That mindset? It's exactly what holds them back. The real secret? The less you tinker, the better you'll do. Let me tell you about Jason. Jason is not a financial expert. He's a public school teacher who started investing in his mid-20s. He didn't pick stocks or chase trends. He simply set up automatic contributions to a low-cost index fund every month and didn't touch it. He didn't panic during market crashes. He didn't try to time anything. He just kept going. Fast forward 25 years. Jason's account had quietly grown to over $400,000. No luck, no genius, just boring, consistent action. Now let me tell you about Eric. Eric loved hot tips. He was always buying the next big thing: tech stocks, crypto, penny stocks. He made money fast and lost it even faster. Every few years, Eric was starting over, convinced the next opportunity would finally be it. Same market, two people, two very different results. So why does this happen? Because we've been sold the wrong story. Wall Street thrives when you believe investing is too complex to handle on your own. That's why they wrap it in jargon and charge you fees to manage your money. The media thrives on panic, it gets clicks. And social media loves showing you overnight millionaires without the years of failure behind the scenes. But real wealth? It's slow. It's simple. It's systemized. The people who win at investing aren't the smartest or the boldest. They're the most consistent. And here's the kicker: the system is already built for you. You don't need to build the ship, you just need to get on board. The market, over time, grows. Yes, it dips. Yes, it crashes. But historically, it has always recovered. Always. Your job isn't to predict the future, it's to participate in the process. Think about that. You don't have to beat the market. You just have to be in it. The moment you stop trying to outsmart investing is the moment you start getting it right. It's not about being clever. It's about being calm. We've been trained to believe that action means value, that doing more means doing better. But when it comes to investing, the opposite is often true. The best investors don't obsess. They automate, they stay the course, and they let time do the heavy lifting. If you've ever felt overwhelmed by investing, take a breath. You're not broken. You've just been fed a noisy, outdated version of how this works. Let's rewrite that story together. In the next chapter, we're going to talk about why the most successful investors embrace what sounds like a dirty word: boredom. It's time to discover why boring might be the most powerful strategy you've never considered. Chapter 2. Boring is the new brilliant. If you want excitement, go to Vegas. If you want to build wealth, embrace the boring stuff. That's not what most people want to hear, but it's the truth. Real investing isn't sexy. It's not fast-paced or dramatic. There are no sudden windfalls, no adrenaline-pumping trades. It's calm, repetitive, predictable, and that's exactly what makes it work. We've been taught to associate progress with action, more effort, more hustle, more movement. But in investing, the smartest move is often to do nothing at all. It's about setting up a simple plan, sticking to it, and letting time handle the heavy lifting. That's not flashy, but it's powerful. Think about a slow cooker. You throw in a few ingredients, set the timer, and walk away. Hours later, you've got a delicious, fully cooked meal. Now compare that to standing over a frying pan, flipping, adjusting, stressing. One is calm and effective. The other is frantic and messy. Good investing is a slow cooker. Let me tell you about Maya. She was 29 when she started investing. She chose a simple index fund, set up automatic contributions from her paycheck, and checked her account maybe twice a year. 10 years later, her account had nearly doubled. Not because she chased trends, but because she trusted the process. Maya never tried to be a market genius. She just made a plan and got out of the way. Now compare that to Dan. Dan was glued to financial news, always looking for an edge. He traded constantly, moving money in and out based on headlines, social media tips, and gut feelings. In the same 10 years, Dan had far more activity, and far less to show for it. His returns barely outpaced inflation. Here's the paradox: the more you try to beat the market, the more likely it is to beat you. The market doesn't reward hyperactivity, it rewards patience. Index funds are the ultimate boring but brilliant tool. They don't try to pick winners, they are the winners, by owning a little piece of everything. Instead of guessing who will thrive, you bet on the entire market. And historically, the market has grown. Slowly, yes, but consistently. And let's talk fees. Active investing might sound impressive, but those management fees? They quietly eat into your returns, year after year. Index funds? Low cost, no drama. More money stays in your pocket. We live in a world that celebrates overnight success. But wealth that lasts isn't built overnight, it's built over time, repetition, discipline, simplicity. That's how real people grow real wealth. Not by finding the next big thing, but by consistently sticking with what works. The biggest advantage you have isn't your IQ or your job title, it's your ability to sit still, to ignore the noise, to keep going when it feels like nothing's happening. Boring is brilliant because it's sustainable. It doesn't rely on emotion. It doesn't burn you out. It doesn't need to be reevaluated every week. It just works, quietly, consistently, and powerfully. So if your investment strategy feels a little dull, that's probably a good sign. It means you're not reacting. You're not panicking. You're focused on the long game, and that's how you win it. In the next chapter, we'll go deeper into what actually causes people to abandon these simple systems. It's not logic, it's emotion. Fear, greed, and impatience are the real enemies of wealth. Let's explore how your brain might be sabotaging your future, and what to do about it. Chapter 3. The Psychology of Money. Your brain versus your wealth. You already know the basics: spend less than you earn, invest the rest, let time work its magic. So why is it still so hard? Because the real fight isn't with the market, it's with your own brain. Our minds were built for survival, not investing. We're wired to react quickly, avoid danger, and seek short-term comfort. That might have helped us run from predators a few thousand years ago, but it's terrible for building long-term wealth. The same instincts that kept us alive now push us to panic when the market dips, get greedy when it spikes, and second-guess every plan we've made. Let me introduce you to Sarah. During the 2008 financial crisis, Sarah had a solid investing plan. She was contributing to her retirement account regularly, mostly index funds, and was on track to retire early. Then the headlines hit. Markets plunged. The value of her account dropped by thousands in just weeks. Fear kicked in. Her gut told her to pull out before it got worse. So she did. She sold everything at a loss. And then, just like it always does, the market recovered. In the years that followed, it not only bounced back, it soared. But Sarah had already missed the rebound. That single emotional decision set her back almost a decade financially. This isn't a rare story. It happens all the time. Studies show that the average investor earns significantly less than the market average, not because of bad investments, but because of bad behavior. Fear and greed are powerful, and they show up at the worst possible times. Your brain wants to keep you safe, and when it sees red numbers, it assumes danger. It tells you to take action, do something, fix it. But investing doesn't work like that. Often, the best thing to do is nothing. Ride it out. Trust the plan. On the flip side, when the market is booming, your brain whispers you're missing out. Suddenly you feel the urge to chase returns, to jump into whatever stock everyone's talking about. You forget your goals. You just want in. This is how we sabotage ourselves, not because we're foolish, but because we're human. The key isn't to eliminate emotion. That's impossible. The key is to build systems that protect you from yourself. Automate your contributions so you don't have to decide each month. Invest in broad, diversified funds so you don't obsess over individual stocks. And most importantly, remind yourself, often, that market ups and downs are normal. Think of it like flying. Turbulence feels scary, but the plane is still on course. You don't grab the controls and start steering. You trust the system. You stay in your seat. Investing is the same. Your plan is the autopilot. Your job is to stay seated. It's not always easy, but it becomes easier when you understand that fear and greed are just signals, not commands. You don't have to obey them. You can feel them, acknowledge them, and keep going anyway. In the next chapter, we'll talk about how to take the first step, even if you feel behind, unsure, or overwhelmed. Starting doesn't require perfection. It just requires movement, and the sooner you start, the more time you give your money to grow. Chapter 4. The Power of Starting Ugly. We tend to think we need everything figured out before we begin. The right job, the right budget, the right amount of money to make it worth it. So we wait, we research, we delay. We tell ourselves we'll start investing once things are more stable, more predictable, more perfect. But waiting is the enemy. The truth is, the earlier you start, even if it's messy, small, or uncertain, the bigger the payoff down the line. Let's meet Carlos. Carlos was 23, working his first full-time job, living in a shared apartment, and eating more instant noodles than he cared to admit. He had no fancy financial background, no windfall. Just a simple idea. What if I put away $50 a month into an investment account? It felt small, almost silly. But he did it anyway. He didn't pick individual stocks. He didn't try to outsmart the market. He just set up an automatic deposit into a low-cost index fund and let it sit. As his income grew, he increased it, first to $75, then $100, then $200. He never made a huge leap. He just kept going. Fast forward 15 years. Carlos has over $80,000 invested. Not because he did anything magical, but because he started when it was still ugly. That's the power of time. Time turns small, imperfect beginnings into something real. It transforms crumbs into loaves, seeds into forests. The earlier you begin, the longer you allow compound interest to do its quiet, powerful work. Most people don't realize how much time magnifies money. If you invest $100 a month starting at age 25 and average a 7% return, by the time you're 65, you'll have over $240,000. If you wait until 35 to start, you'll end up with just over $120,000. That's half the result, for the same effort, just because you waited 10 years. Here's the part most people miss. It's not about how much you start with, it's about when. And the answer is always the same: start now. Ugly starts are better than no starts. Even if you're in debt, even if your income is tight, even if you're confused by all the options, The habit matters more than the amount. You can learn as you go, you can tweak your plan later, but you can't go back and add more time. There's a myth that you need to be ready to invest. But readiness is often just a mask for fear. Fear of messing up. Fear of losing money. Fear of looking stupid. The irony is, not starting is the only real mistake. You don't need to know everything. You don't need to be rich. You don't even need confidence. You just need motion. Open an account. Set up a small recurring deposit. Let the process begin. Let it be imperfect. Let it be enough. There's a saying in fitness, the best workout is the one you actually do. The same is true with investing. The best plan is the one you actually start. No plan is perfect on day one, but it can become powerful over time. In the next chapter, we'll dive into one of the smartest, easiest tools for beginner investors, and pros alike, index funds. You'll see why this one simple vehicle can carry your financial future, even if you never touch a stock ticker in your life. Chapter 5. Index funds, the greatest wealth hack most people ignore. If there's one investing tool that quietly builds wealth without requiring genius, guts, or constant attention, it's the humble index fund. No hype, no headlines, no heroic timing, just steady, consistent growth over time, and yet, most people have never even considered using one. So what is an index fund? It's a simple investment that tracks a specific slice of the market. Instead of trying to pick individual winners, it buys a small piece of every company in a given index, like the S&P 500. When the market goes up, your fund goes up with it. When the market dips, your fund dips too. It mirrors the market's long-term performance, minus the drama. Meet Denise. Denise didn't want to become a stock picker. She had no interest in learning the difference between PE ratios and earnings reports. She just wanted her money to grow while she focused on building her business and spending time with her family. So she chose a low-cost index fund that tracked the total U.S. stock market. She set up automatic monthly contributions and ignored the daily fluctuations. 20 years later, Denise had built a 7-figure investment portfolio. Not by being clever, not by chasing trends, just by owning the market. Now contrast that with Marcus. Marcus tried to outsmart the system. He jumped in and out of stocks based on tips, tweets, and trends. Some years he did well. Other years he lost big. His results were unpredictable, and after a decade of effort, he found himself barely ahead if at all. Denise didn't just save time and energy, she saved money too. Index funds have incredibly low fees because they don't require active management. There's no team of analysts trying to beat the market, the fund simply follows it. Those savings and fees might seem small, 0.5% here, a full percent there, but over decades, they can mean tens or even hundreds of thousands of dollars more in your pocket. And here's the kicker, most professional investors can't consistently beat the market anyway. Study after study has shown that over the long run, index funds outperform the majority of actively managed funds. So why pay more for worse results? Still, many people ignore index funds because they sound too simple. We're drawn to complexity. We want to believe that success must be difficult. But simplicity isn't weakness, it's strength. Simplicity is sustainable. Simplicity doesn't break under pressure. If you're someone who doesn't want to spend hours researching stocks, if you want a hands-off, no-nonsense way to grow your money, index funds are your best friend. They take emotion out of the equation. They let you invest consistently, without second-guessing. And they give you exposure to the growth of the overall economy, without needing to pick the winners in advance. Owning an index fund is like buying a piece of every major company at once. Some will fail, some will thrive. But on average, the group rises, and by staying in, you rise with it. Investing doesn't have to feel like gambling. It doesn't have to feel like work. With index funds, you get a front-row seat to the natural expansion of the economy. You don't need to sprint, you just need to keep walking forward. In the next chapter, we'll talk about how to turn this into a seamless routine. What if your investments happened automatically, without you even thinking about it? Let's explore how automation can turn discipline into destiny. Chapter 6. Automate your wealth like a lazy genius. If there's one superpower in personal finance, it's automation. The less you rely on willpower, the more consistent you'll become. And consistency, not intensity, is what builds wealth over time. Imagine if saving and investing could happen without you lifting a finger. Not because you're disciplined every day, but because you made a smart choice once and let it run in the background. That's the magic of automation. It turns good intentions into real results. Take Jeremy, for example. Jeremy was great at making plans but terrible at following through. Every month, he'd tell himself he'd transfer money into his investment account, after paying bills and covering the essentials. But by the end of the month, there was always some excuse: a birthday, a car repair, a dinner out that turned into 3. He wanted to save, he really did, but life kept getting in the way. Then one day, Jeremy flipped the script. Instead of saving what was left over, he decided to invest first. He set up an automatic transfer to his Roth IRA the same day he got paid, at just $200. Before he even saw the money, it was gone, sent directly into a low-cost index fund. He didn't have to think about it, plan for it, or resist the urge to spend it. It just happened. 6 months later, Jeremy had more saved than he'd managed in the previous 2 years combined. This is what the pros call paying yourself first. But automation makes it bulletproof. It removes emotion from the process. No more deciding if it's the right time. No more checking the market before every move. Just a simple, recurring system that works in the background while you live your life. The best part? You can automate almost everything. Your paycheck hits your bank account. From there, a set amount moves to your investment account. Your investment account is already set to buy shares of your chosen fund. You never even have to log in. It's like setting up a subscription, but instead of paying for streaming services, you're building wealth, quietly, reliably, month after month. And don't worry if you can't start big. Automation isn't about how much you move. It's about the habit. Even $25 a month, done consistently, adds up. You can always increase the amount later. What matters most is starting the engine. You might be wondering, what if the market crashes right after I invest? What if I'm buying at the wrong time? That's the beauty of automation. By investing the same amount at regular intervals, a strategy called dollar cost averaging, you naturally buy more when prices are low and less when they're high. Over time, this smooths out the ride. Automation doesn't mean you never check in or make changes, but it creates a strong default. You're not starting from zero each month. You've built a system that works for you, even when you're busy, distracted, or tired. Building wealth shouldn't depend on daily discipline. It should rely on structure. Systems beat moods, and the simplest system of all is to automate the things that matter most. In the next chapter, we're going to talk about what threatens this system more than anything: noise. The headlines, the social media hot takes, the predictions and panic. If you've ever felt anxious or confused about the market, you're not alone. But learning how to tune it out might be the smartest financial move you ever make. Chapter 7. Tune out the noise, or stay broke and anxious. The market is crashing. Experts warn of a recession. This one stock is about to explode. If you've ever turned on the news or scrolled through social media, you've seen headlines like these: loud, urgent, dramatic. They're designed to grab your attention, and they do. But the problem isn't the noise itself. It's what the noise does to your brain. Noise triggers emotion, fear, excitement, doubt, and when emotions spike, logic tends to shut down. That's a dangerous mix when it comes to investing, because investing rewards patience, not panic, long-term thinking, not click-driven reactions. Let's go back to the beginning of 2020. The pandemic hit, and the market tanked. In just a few weeks, people watched their portfolios drop by 30% or more. The headlines were terrifying. Words like collapse, depression, and unprecedented were everywhere. Investors fled the market in record numbers, pulling out money just to feel a sense of control. And then, the market recovered. Fast. In fact, by the end of the year, the market had not only bounced back, it had hit new highs. But many of those who sold in fear missed that rebound. Their losses weren't just on paper. They were real. Now meet Alicia. She saw those same headlines. She felt the same fear. But she didn't touch her investments. She took a walk instead. She reread her plan. She reminded herself that markets go down, but they also come back up. So she stayed put, and her account followed the recovery, growing steadily in the months and years that followed. Alicia didn't ignore reality. She just tuned out the noise. There's a big difference. The media isn't designed to make you rich, it's designed to keep you watching. And fear is a great hook. The more dramatic the story, the more clicks it gets. But investing success doesn't come from being the most informed, it comes from being the most consistent. That's not to say you should live under a rock. Staying aware of big trends is fine, but reacting to every headline, that's a recipe for stress and poor decisions. Think of the market like the ocean. There will always be waves, some gentle, some wild. You don't need to predict each one. You just need a strong boat and the patience to stay on course. Your investment plan is that boat. The noise is the storm. Your job is to hold steady. You'll hear predictions constantly. This year will be the crash. That sector is going to boom. A recession is coming. Or maybe not. The truth? No one knows. Not really. Even the experts get it wrong all the time. The ones who are right one year are wrong the next. Building your plan around predictions is like building a house on sand. So how do you tune it out? You commit to your system. You automate your contributions. You stop checking your accounts every day. You focus on what you can control, how much you save, where you invest, how long you stay in. And when the noise gets loud, you come back to your plan. Because noise doesn't build wealth. Quiet discipline does. In the next chapter, we'll break down one of the most misunderstood parts of investing: risk. Most people think it means danger. But when you understand what risk really is, and what it isn't, you'll see it's not something to fear, it's something to manage. Chapter 8. Risk isn't what you think it is. When people hear the word investing, the next word that usually comes to mind is risk. And not the good kind. They picture danger, loss, regret. They imagine their hard-earned money vanishing overnight. That fear is what keeps many people on the sidelines. But here's the problem: most people misunderstand what risk actually is. We've been taught to think of risk as the chance that something bad will happen. But in investing, risk is more nuanced. It's not just about losing money, it's about the possibility of fluctuations, volatility, the ups and downs that come with being in the market. But volatility isn't the same as loss. Losing money only becomes real if you sell at the wrong time. Until then, it's just numbers on a screen, going through their natural cycle. The market rises, falls, then rises again. That's not risk. That's rhythm. Let's look at two friends, Jasmine and Leo. Jasmine started investing in a broad index fund, and planned to leave the money alone for at least 20 years. She understood that some years would be rocky. In fact, just 1 year after she started, the market dropped by 15%. But she didn't panic. She stayed the course, kept contributing, and reminded herself she was playing the long game. Leo, on the other hand, saw the same dip and bailed out. Too risky, he said. He moved everything into a savings account, earning barely 1%. He felt safer, but his money stopped growing. Fast forward a decade. Jasmine's portfolio recovered, then multiplied. Leo's? It just sat there. Safe, but stagnant. What's more risky, riding out market swings with a plan in place, or avoiding them entirely and falling behind over time? Here's a truth that might surprise you: not investing is also a risk. Inflation chips away at your money's value every year. Sitting on cash might feel safe, but it guarantees that your purchasing power shrinks over time. You don't see the loss on a statement, but it's real, it's quiet, and it's constant. Risk isn't about short-term discomfort, it's about long-term consequence. And you don't have to go all in to manage it well. That's where diversification comes in. By spreading your money across many companies, industries, and even countries, you reduce the impact of any one loss. One company tanks? You're fine. One sector underperforms? You've got dozens of others. Think of it like a buffet. If one dish isn't great, no problem, you've got 10 more. Diversification turns risk into something manageable, something you don't have to fear. Time helps too. The longer your investment horizon, the less those bumps matter. Over short periods, the market is unpredictable. But stretch that timeline to 10, 20, 30 years, the trend has always been up. Not perfectly, not smoothly, but reliably. We're not saying there's no risk in investing. Of course there is. But risk doesn't mean reckless. Risk means opportunity. It means movement. It means growth. The key is to respect it, not run from it. Don't let fear define your future. Get clear on what risk really means and how much you can handle emotionally, then build a plan that fits. The goal isn't to eliminate all risk, it's to make smart choices within it. In the next chapter, we'll show you how to create that smart balance through diversification. You'll see how to build a portfolio that feels stable, even when the world doesn't. Chapter 9. Diversification, your secret safety net. Imagine going to a restaurant and ordering only one thing. If it's great, awesome. But if it's bad, your whole meal is ruined. Now picture a buffet. You try a little of everything. If one dish disappoints, no big deal, you've got a full plate. That's what diversification does for your investments. Diversification means not putting all your eggs in one basket. It means spreading your money across different assets so that no single one can wreck your entire plan. It's not flashy, it's not exciting. But it's one of the smartest moves any investor can make. Let's say you invest in just one company, and that company tanks. You're out of luck. But if you invest in 100 companies, one flop barely makes a dent. That's the power of having a broad base. Meet Tara. Tara used to pick individual stocks. Sometimes she won big, but other times she lost hard. The emotional roller coaster exhausted her. Eventually, she made a shift. She moved her money into a diversified index fund that held shares in hundreds of companies across multiple industries. No more trying to guess winners. No more stress. Her portfolio grew steadily, and she slept better at night. Diversification isn't just about owning multiple stocks. It's about owning a mix of assets that behave differently. Stocks, bonds, real estate funds, each plays a role. When one zigzags, another might stay steady. It's like building a team. You don't want all sprinters or all goalkeepers. You want a balance that works together. During market crashes, diversification acts like a cushion. You might still feel the impact, but it softens the blow. And during growth periods, it keeps you moving forward without exposing you to unnecessary risk. Some people worry that diversification limits their upside. They think, if I bet it all on one stock and it takes off, I'll make a fortune. Sure, that could happen. But that's not investing, that's gambling. For every overnight success, there are hundreds of quiet failures. Diversification doesn't guarantee you'll get rich fast. It helps you build wealth that lasts. And the good news? You don't need to handpick dozens of investments yourself. Index funds and ETFs, exchange-traded funds, do the heavy lifting for you. A single fund can give you instant exposure to hundreds or even thousands of companies. It's simple, efficient, and incredibly effective. Diversification also helps manage your emotions. When one part of your portfolio drops, others can hold steady or rise. That balance keeps you from panicking. It keeps you invested, and staying invested is the name of the game. There's a reason every respected financial advisor talks about diversification. It works. Not because it's trendy, but because it's time-tested. It's the strategy behind nearly every successful long-term investor. You don't have to build an elaborate portfolio. Just make sure your money isn't leaning too heavily in one place. A well-diversified plan gives you confidence. It lets you breathe. It gives you room to ride out storms without jumping ship. Think of it as your financial safety net. You may not notice it every day, but when things go sideways, you'll be glad it's there. In the next chapter, we'll shift gears and speak directly to those who feel intimidated by numbers. You don't have to love math to master investing. In fact, the best strategies are often the simplest. Let's prove that in real terms. Chapter 10. Investing for people who hate math. Let's get something out of the way. You do not need to be a math person to become a successful investor. In fact, the best investors often use the least math. They don't obsess over formulas or spreadsheets. They understand basic concepts, make smart decisions, and let time do the work. Still, a lot of people hesitate to start because they think they need to crunch numbers, analyze charts, or understand compound interest down to the decimal. But investing isn't a math test, it's a behavior game. Your ability to stay consistent, stay calm, and stay invested matters far more than your ability to calculate internal rates of return. Take Noah. Noah hated math. He avoided it in school and never used it in his job. When it came to investing, he kept it simple. He automated $300 a month into a total market index fund. He didn't try to calculate exact outcomes, he just knew more time in the market meant more growth. 15 years later, Noah had built a portfolio worth over $100,000. No complex calculations. Just action. If you understand a few basic ideas, you're already ahead. First, compound interest. This is just a fancy way of saying that your money earns money, and then that money earns more money. Imagine you invest $1,000 and it earns 7% in a year. Now you have $1,070. Next year you earn 7% on that amount, not just the original $1,000. So now it grows to $1,145. And it keeps going. Over time, the growth snowballs. That's compounding. Second, dollar cost averaging. It sounds technical, but it's simple. It just means investing the same amount regularly, regardless of what the market is doing. Some months you buy when prices are high, other months when they're low. Over time, this smooths out your cost. You're not trying to time the market, you're just showing up consistently. Third, diversification. We've already covered this, but it's worth repeating. It's better to own small pieces of many things than bet everything on one. This spreads your risk and increases your odds of long-term success. That's it. You don't need to calculate standard deviations or analyze earnings reports. You don't need to predict which sector will outperform this year. In fact, trying to do that often leads to worse results. The real challenge isn't math, it's mindset. Can you keep going when the market dips? Can you ignore the noise and stick to your plan? Can you stay invested even when it feels uncomfortable? That's the test. And you don't need a calculator to pass it. So if numbers aren't your thing, good news. You're off the hook. You don't need to love math. You just need to take simple actions, consistently over time. Use tools that make it easier. Most investment apps and platforms do the math for you. They show you your contributions, your growth, your average returns. You're not building a rocket ship, you're planting a tree. Water it regularly, give it time, and it will grow. We've spent too long thinking investing is only for experts. It's not. It's for anyone who's willing to learn a little and do a lot. Your brain doesn't need to be a calculator, it just needs to be calm, clear, and committed. In the next chapter, we're going to take everything we've talked about and put it into action. How should you handle each dollar you earn? Where should it go? And in what order? You'll walk away with a simple, repeatable plan that makes your money work for you. Chapter 11. Your simple plan. What to do with every dollar you earn. Most people don't have a money plan, they have money habits, and those habits usually involve spending first and hoping there's something left to save later. But if you want to build wealth, you need to flip the script. You need to tell your money where to go before it disappears. The good news is that the plan doesn't need to be complicated. In fact, the simpler it is, the more likely you are to stick with it. We're going to give every dollar a job. We're going to assign it a role in your future. Think of it like building a team. Some dollars protect you, some grow your wealth, and some give you freedom and fun along the way. Let's say you bring in $1,000. Before you pay a single bill or buy anything, pause. Where should that $1,000 go? Start with the foundation, your emergency fund. If you don't have at least 1 month of expenses saved, that's priority 1. It's your safety net. Life will throw surprises your way: car repairs, medical bills, sudden layoffs. Your emergency fund makes sure you don't have to go into debt every time something goes wrong. Once you've got that first buffer, aim for 3 to 6 months of expenses over time. Next comes investing. If your job offers a 401k with a match, start there. That match is free money. It's a guaranteed return just for showing up. Contribute at least enough to get the full match. After that, if you can, open a Roth IRA. It grows tax-free, and when you retire, the withdrawals are yours to keep. If you still have more to invest, circle back to your 401k or open a regular brokerage account. Now let's not forget spending. You need to live your life. Set aside money for essentials, rent, groceries, transportation, but also budget for enjoyment. Fun is not the enemy of progress. It's part of a sustainable plan. Just do it with intention. You're not guessing where the money goes, it's already decided. The real power of this system is that it's flexible. Your income may change, your priorities will shift, but the structure stays the same. Every dollar has a job. You don't waste time wondering if you can afford to invest or save, you've already built it into the plan. This kind of intentionality turns money from a source of stress into a source of control. You're not reacting. You're directing. You're not hoping things work out. You're making sure they do. And yes, life will throw curveballs. Some months will be tight. Some goals may pause. But when you've got a simple plan in place, you always know what to come back to. That consistency is what creates results over time. Don't wait for the perfect budget or the perfect moment. Start now. Decide how you'll split your next paycheck. Automate what you can. Adjust when needed. This is your blueprint, not just for surviving but for building a future that actually feels like freedom. In the final chapter, we'll bring it all together. You've learned the strategies, you've seen the steps. Now it's time to move from learning to action, because nothing changes until you start, and starting is all it takes. Chapter 12. Just start. Don't look back. By now you've seen the truth. Investing doesn't have to be complicated, loud, or intimidating. It doesn't require you to be a math whiz, a market expert, or someone who watches finance videos before bed. You just have to begin. Because the biggest difference between people who build wealth and those who don't comes down to one thing: action. Too many people spend years waiting for the right moment. They want to feel ready. They want certainty. But in investing, waiting is its own form of risk. Every month you sit on the sidelines is a month you could have been growing. A month you could have been learning. A month you could have let time do its quiet, magical work. Starting isn't about perfection. It's about motion. You don't need the best account or the best fund or the best market conditions. You just need to open the door and step through. Once you do, the rest unfolds. You'll learn by doing. You'll adjust along the way. And most importantly, you'll be in the game. Let's go back to the person you were when you opened this book. Maybe you felt overwhelmed. Maybe investing seemed like something other people did, people with more money, more knowledge, more confidence. But now you know better. You've got the tools, you've got the map, and you've got a reason. You're not investing just for the numbers. You're investing for freedom. For options. For the ability to walk away from a job you've outgrown, or take a trip without stressing about the bill, or help your kids without draining your own future. That's what this is really about. Building wealth isn't a sprint. It's not even a straight line. It's a long, winding walk that rewards those who keep showing up. You'll have months where it feels like nothing's happening. You'll face moments of doubt. You'll hear advice that makes you second-guess your plan. But if you keep going, if you trust the process, you'll look back years from now and be amazed at how far you've come. And you won't need to check your account every day. You won't need to chase the latest trend. You'll be at peace, knowing your money is working quietly, patiently, relentlessly. There's a saying in personal finance: the best time to start investing was yesterday. The second best time is today. So today, let's make a decision. Not a massive one. Just a single step. Maybe it's opening your first investment account. Maybe it's setting up that automatic transfer. Maybe it's finally letting go of the fear that's kept you frozen. Whatever it is, do it now. Don't wait until everything feels perfect. Perfect is a moving target. Progress is what matters. You have everything you need, not someday, right now. You've learned how the market works, how to protect yourself from noise, how to build a simple plan, and how to avoid the mistakes that trip up most people. That puts you ahead of the curve. This isn't the end of your journey. It's the beginning. Every dollar you invest is a vote for your future. Every consistent step is a brick in the foundation of a life with more freedom, more peace, and more possibilities. So take the first step. Don't look back. Your future self is already cheering you on. Take care and be well.